Thank you, Jack.
Great to
Hey,
be
Jack,
here,
how are
Jack.
you doing, Joseph?
Hey, nice, thanks.
I'm glad that you two could finally meet. Alfonso, I set the stage a little bit. Could you just explain, uh, number one, why did you want to have a meeting today? Well, today is such a historic day. And two, if I were to ask you the very open-ended question that's very hard to answer, why are things selling off? Why do we have such volatility in markets? What would you say?
You always ask easy questions, Jack. That's why I like you. So the reason why I want to have a meeting today is that this is one of the what I call the margin call days. So margin call days when you're levered up to your nose and you have drawdowns that are much larger than you would expect, and therefore you get so-called margin calls, which means you have to put up cash, dollars, to make sure that you can effectively delever and close your positions. And let's say that I've been there with the risk manager stopping me on the shoulders a couple of times. And these episodes are generally interesting to analyze. Despite being a margin call day, Jack, as I call it, there are good macro underlying reasons why this sell-off has been going on now for the good part of 6 months. And I think we should discuss those too.
Joseph, what do you say?
I agree completely. Today is going to be a margin call day. When I think about this, one way to think about this is to think about it. Let's say the Elon and Twitter deal, right? Elon wants to buy Twitter, and he puts up a lot of Tesla stock as collateral. We all know where that price is, right? Now, suppose the price of a Tesla stock drops below a certain level, then all those brokers who lent him money against that Tesla stock are going to have to liquidate that, right? So you can have these nonlinear avalanches and happen. And so that's the same with anyone else in the market. A lot of people play the market with a lot of leverage, and once they get to a certain level, their brokers are going to have to sell their asset holdings in order to make margin, and that makes prices go down. More people get margin calls, so you can have a very disorderly situation.
Joseph, I want to read from your most recent article on FedGuide.com. You say the money supply is set to contract just as investors are clamoring for cash to hide from declines in both equities and bonds. That one sentence contains like three things I want to dig into. But let's the most pressing issue, which is stocks and bonds going down together. Alfonso, you buy stocks, that's a risk asset, but you hedge it with bonds. So when stocks go down, your bonds go up. But as investors are learning today, and very painfully so, as well as up until this very year, stocks and bonds have been going down together. So what do you guys make of that? How about we start with you, Joseph?
Well, that means there's no place to hide, right? So what was usually, let's say people usually hide in bonds, as you noted, but possibly because inflation is rising, there's bonds are not the safe haven they used to be. People are selling bonds as well, possibly also because of quantitative tightening, and you're changing marginal buyers. There's less, I guess, some uncertainty in the market as to who the marginal buyers would be, and so bonds are selling off. And so when this happens, there's really nowhere to go except cash, and strangely enough today, oil is actually green today, and I very, very keen to ask Alpha on his thoughts on that. Is oil the safe haven, the new gold? But so going forward, though, like you mentioned, Jack, we have three things that are happening, I think, when it comes to the Fed. We have the increased tightening from the front end that the Fed is going to do, and we can talk about what will happen at the Fed meeting. We have QT, which is basically increasing the supply of treasuries, and its QT is also withdrawing liquidity out of the system. So there's a lot of tightening going on. I think the market is going to have to be trying to price that going forward, and it's going to be, I think, a pretty bumpy ride.
A bumpy ride, Alf.
So, Jack, let's start from what's happening in the bond market. I mean, we have Joseph here, so I can't think of anyone better to discuss this. Let's say that you have, if you look at the last 2 or 3 decades, every time that inflation expectations were below 2.5%, you had a negative correlation between long-term bonds and stocks. And why that is the case? Because as our system is effectively based on credit creation, if this credit creation is done at cheaper borrowing rates, so at easier financial conditions, credit can flow through the economy in an easier way. Animal spirits can actually run, and we can get those inflation expectations all back up where we want them to be, roughly between 2 and 2.5%. So when these inflation expectations are below these levels, then there is quite a negative correlation between bonds and stocks, because if stocks are dropping, Jack, then what's happening is that you have the Federal Reserve that can accommodate. They look at inflation expectation, they are relatively low, they can accommodate, they can ease, they can cut rates, they can do QE, and so bonds tend to rally. And therefore you have this inverse correlation that actually works. It's quite a great asset to have bond in your portfolio to protect from your drawdowns back then. Now, if you now try to run the same analysis where inflation expectations are above 2.5% to 3%, you will soon realize that this correlation doesn't work anymore. This inverse correlation actually flips and becomes a positive correlation. So I sent you some charts, Jack. I don't know whether you're able to put them on the screens or not. If you look at 5-year inflation expectations in the US, we were at roughly 2.8% in October last year, but also in February this year. 2.8% is already relatively high. And then we spiked all the way up to 3.6% for the next 5 years. So those are market implied expectations for inflation over the next 5 years, let's say on average, over the next 5 years. The thing which is not in this chart is the distribution of these expectations, Jack. And the right tail, where people are expecting inflation above 5% over the next 5 years, is now becoming fatter. If you look at the options implied under these markets, it's roughly 15% now. 15% of traders expect inflation to average 5% in the US over the next 5 years. You can understand that when that is the case, the Federal Reserve cannot accommodate financial conditions anymore, cannot look at that side of the equation as importantly as they were looking at it before, when inflation expectations were 2%. And so what happens is that they need to bring basically real interest rates to a higher level so that they can slow down inflation. And when that happens, bonds just don't work anymore.
That's a really good explanation. Just so the audience knows, so a lot of when you go up to the medium term in interest rates, a lot of it is expectations of what the Fed will do. So let's say where the 5 years is where the market expects the Fed will keep the overnight rate over the next 5 years. But as Alf mentioned, so when you have high inflation, you can't expect the Fed to be cutting rates to make sure that the stock market goes higher. When you have high expectations, your expectation is for the Fed to continue to raise rates. So right now what's happening is, even though the stocks are selling off, the market expects the Fed to continue to raise the short-term rates to tame inflation. So that correlation, that safe haven trade that we used to have in the bonds, won't exist anymore. Now stocks sell off, bonds also sell off, because as Alf showed us, that chart, it's a beautiful chart, these inflation expectations are rising, Fed has to increase interest rates as well.
And I want to put up another chart by Alf, which is, let's see, the market implied U.S. terminal rate. So while I get that up, Alf, just explain what a terminal rate is. And also, I saw some comments saying that my mic is too loud. I turned the volume down. So folks, let me know in the comments if my mic is still too loud.
So we bond traders are weird guys. We work based on expectations, Jack. So what we're trying to do here is we're trying to price what is the highest implied point at which the federal funds rate will be through this hiking cycle. And we do this via forward interest rates. It can be pretty complicated. It's not really. What we do is we extrapolate through the curve what will be the highest interest rate the Federal Reserve will be able to reach in this hiking cycle. And you can see the market changed their mind a lot over here. So first they thought it was 1% and 1.5%. And then basically from March, April 2022, the market started to sing another tune. And we saw this market implied terminal rate move all the way up to 2.5%, then to 3%. And then we thought that was it, right? Until we got our last bout of volatility up to almost 4%. And now I get this question a lot. Alf, how the heck can they hike to 4% Fed funds rate with such an over-leveraged economy, such an hyper-financialized markets? I mean, how can they hike to 4%? What's going on here is the market is chasing what will be the marginal cost of dollars that will cause demand destruction. What is the price at which you don't go and borrow to buy a new house? What is the price at which corporates have problems refinancing and therefore they have to shrink their business because refinancing it is too expensive? What is the point at which you are not going to get a lease to buy your car, your next car again? what is that cost of dollars adjusted for inflation that is required for you to basically pare down your spending and your animal spirits? That's what the market is chasing here. That's why it's bringing these rates as high as it will be necessary till demand really slows down.